Question 1. General insurance. Risk management concepts. An underwriter is evaluating potential insured's application. The insured's property is located in an area prone to wildfires. The applicant requests additional coverage for wildfire damage. Which underwriting approach should the underwriter take to minimize adverse selection? Offer full coverage with higher premium to offset the risk. B. Decline the application due to the high-risk location. C. Require the applicant to install fire suppression systems as condition for coverage. D. Provide standard coverage and rely on state-backed reinsurance for wildfire risks. Answer. C. Require the applicant to install fire suppression systems as a condition for coverage. Explanation. Adverse selection occurs when high-risk individuals are more likely to seek insurance, potentially causing losses for the insurer. To manage this, underwriters often implement risk control measures to reduce exposure. In this case, requiring fire suppression systems reduces the insurer's risk without outright declining coverage, which could violate anti-discrimination laws under the California Insurance Code. SIC. Offering full coverage at a higher premium. Option A could lead to unaffordable rates and regulatory concerns, while state-backed reinsurance, option D, is typically a last resort for insurers. Question 2. Scenario-based question. Liability insurance. Legal liability. Mark owns pet grooming business in California. One day, customer's dog escaped from his facility and causes serious accident on the nearby road, injuring cyclist. The injured party files lawsuit against Mark, claiming negligence. Under California liability insurance laws, which type of liability coverage would best protect Mark from this claim? A. Professional liability insurance. B. General liability insurance. C. Umbrella liability insurance. D. Workers' compensation insurance. Answer. B. General liability insurance. Explanation. General liability insurance provides coverage for bodily injury, property damage, and personal injury claims that arise from the business's operations. In this scenario, Mark's negligence in securing the customer's dog resulted in third-party injury, making it covered event under his general liability policy. Professional liability insurance, option A, typically covers errors and omissions. Professional services, but it doesn't extend to general negligence causing bodily harm. Umbrella liability insurance, option C, provides additional limits but doesn't replace the need for primary general liability coverage. Workers' compensation insurance, option D, covers employee injuries, not third-party claims. Relevant reference: California Insurance Code, SIC. Section 560 outlines the responsibilities of business to maintain adequate liability coverage for third-party claims. Question 3. Property insurance. Homeowners policy exclusions. Which of the following losses is most likely to be excluded under standard California homeowners policy? HO3. A. Kitchen fire caused by faulty electrical appliance. B. Flood that damages the basement. C. Vandalism that occurs while the home is temporarily vacant for 15 days. D. Windstorm that damages the roof. Answer. B. A flood that damages the basement. Explanation. Standard HO3 homeowners policies typically exclude flood damage, requiring homeowners to purchase separate flood insurance through the National Flood Insurance Program and FIP. Options are damage and option D, windstorm damage, are covered perils under the policy. Option C, vandalism, is covered as long as the home hasn't been vacant for more than 60 consecutive days, according to the California Insurance Code, SIC, sections 380 and 381. Question 4. General insurance. Contract law and insurance policy is considered a contract of adhesion in California. What does this mean from legal standpoint? A. The policyholder can negotiate the terms of the contract with the insurer. B. The insurer has the right to modify the policy terms at any time. C. The policyholder must either accept the contract as written or reject it in its entirety. D. Both parties must mutually agree on every policy term before it takes effect. Answer. C. The policyholder must either accept the contract as written or reject it in its entirety. Explanation. A contract of adhesion means that one party, the insurer, drafts the contract, and the other party, the policyholder, has no negotiating power. The policyholder must accept the terms as written or refuse the contract altogether. These types of contracts are common in insurance, but California courts tend to interpret any ambiguity in favor of the policyholder, as they did not have an opportunity to negotiate the terms. Option is incorrect because policyholders generally cannot negotiate insurance contracts. Option B is incorrect because insurers cannot unilaterally change policy terms without notice and agreement. Option D is incorrect because insurance policies are not bilateral contracts in the traditional sense. Relevant reference: California Civil Code Section 1654 governs the interpretation of ambiguous contracts. Question 5. Liability insurance. Negligence and defenses. Which of the following defenses is most likely to succeed in reducing liability for an insured who is sued for negligence in California? A. Absolute liability. B. Assumption of risk. C. Rescission. D. Proximate cause. Answer: B. Assumption of risk explanation. The assumption of risk defense applies when the injured party voluntarily accepted the risks associated with a particular activity. In California, this defense can reduce or eliminate liability if it is proven that the plaintiff was aware of the risks and willingly accepted them. Optional absolute liability is not a defense. It refers to situations where liability is imposed without proving fault. Option C, rescission, refers to cancelling a contract due to misrepresentation or fraud, not a negligence defense. Option D, proximate cause, refers to the cause of the injury but is not a defense strategy. Relevant reference: California Civil Code Section 1714 governs negligence and liability. Question 6. Scenario-based property insurance. Homeowners policy duties after loss. Jessica owns home in Los Angeles. Severe windstorm causes extensive damage to her roof. Following the storm, she delays reporting the claim to her insurer for several months. When she finally reports the damage, her insurer denies the claim due to her delayed notice. Which provision in Jessica's homeowners policy, Hothery, justifies the insurer's denial? A. The policy's deductible clause. B. The exclusions section. C. The duties after loss provision. D. The replacement cost provision. Answer: C. The duties after loss provision. Explanation: Homeowners policies require insureds to promptly notify the insurer of any losses. Failure to do so can result in a denial of the claim under the duties after loss provision. The purpose of this provision is to allow the insurer to investigate and mitigate further damage. Options or deductible clause relates to the amount the policyholder must pay before insurance kicks in. Option B, exclusions section, lists events that are not covered but does not pertain to delayed reporting. Option D, replacement cost provision, addresses how claims are paid but is irrelevant to this scenario. Relevant reference: SEEK Section 2071 outlines the required provisions in fire and homeowners policies. Question 7. Automobile insurance. Personal auto policy exclusions. Which of the following is excluded under standard personal auto policy (PAP) in California? A. Liability coverage for rented vehicle. B. Damage caused by natural disaster. C. Intentional damage caused by the insured. D. Medical payments coverage for the insured's injuries. Answer: C. Intentional damage caused by the insured. Explanation: Insurance policies generally do not cover intentional acts by the insured. In the case of auto insurance, if the insured causes damage on purpose, the insurer will deny the claim. Option was liability coverage for a rented vehicle is covered under most PAP policies through rental car coverage. Option B, damage caused by a natural disaster, is typically covered under comprehensive coverage. Option D, medical payments, is included in personal auto policies as a standard coverage. Question 8, property insurance. Commercial property policies. Under commercial property policy, which of the following is not covered under the business income coverage form? A. Loss of income during the period of restoration. B. Continuing fixed expenses such as rent. C. Payroll for employees during covered loss. D. Costs to repair the physical building damage. Answer: D. Costs to repair the physical building damage. Explanation: the business income coverage form is designed to cover loss of income and continuing expenses while a business is unable to operate due to a covered loss. However, it does not cover building repairs, which are covered under the building and personal property coverage form. Options A, B, and C are all part of the business income coverage. Question 9. General insurance. Types of insurers. Which type of insurer is chartered in California and operates only within the state? A. Domestic insurer. B. Foreign insurer. C. Alien insurer. D. Reciprocal insurer. Correct answer: A. Domestic insurer. Explanation: a domestic insurer is an insurance company that is incorporated and licensed in the same state where it operates. In this case, a domestic insurer is chartered in California. Option B, foreign insurer, refers to an insurer operating in California but chartered in another state. Option C, alien insurer, refers to an insurer from another country. Option D, reciprocal insurer, is a type of mutual insurer but does not specify the insurer's origin. Question 10, liability insurance. Professional liability policies. Which of the following professionals would be best protected by professional liability policy rather than a general liability policy? A, restaurant owner. B, real estate agent. C, clothing store owner. D, landscaping business owner. Answer B, a real estate agent. Explanation. Professional liability insurance covers errors, omissions, and negligence in providing professional services. Real estate agents face a higher risk of errors in transactions that can result in financial losses for clients, making this coverage essential. Options A, C, and D are better protected by a general liability policy which covers bodily injury, property damage, and personal injury claims. Question 11, life insurance. Beneficiaries and claims. Which of the following beneficiaries is not eligible for the death benefit under life insurance policy if the insured is found to have committed suicide within the contestability period in California? A, spouse of the insured. B, child of the insured. C, business partner of the insured. D, the primary beneficiary listed in the policy. Answer D, the primary beneficiary listed in the policy. Explanation. In California, if the insured commits suicide within the contestability period, typically within 2 years, the beneficiary may not receive the death benefit and the insurer may return the premiums paid to the beneficiary. This applies regardless of whether the beneficiary is a spouse, child, or business partner, as the exclusion applies to all types of beneficiaries. Option was a spouse, B, child, and C, business partner are still eligible for premiums returned, but not the death benefit if suicide occurs within the contestability period. Option D, primary beneficiary, is still the primary recipient of any refunds but not the death benefit under this condition. Relevant reference, California Insurance Code Section 10113.1, Suicide Exclusion. Question 12, health insurance. Care requirements under the Affordable Care Act account. Which of the following is not required to be covered under all individual and small group health insurance policies in California? A, maternity care. B, emergency services. C, prescription drugs. D, elective cosmetic surgery. Answer D, elective cosmetic surgery. Explanation. Under the account, health insurance policies must cover essential health benefits including maternity care, emergency services, and prescription drugs, but elective cosmetic surgery is not considered an essential benefit and is not required to be covered. Options A, B, and C are essential health benefits and must be covered under all individual and small group policies. Option D, elective cosmetic surgery, is excluded unless specified under specific plans. Relevant reference, California Insurance Code Section 10112.27, Essential Health Benefits. Question 13, commercial insurance. Workers' compensation. An employee of California-based construction company is injured on the job and files for workers' compensation benefits. Which of the following is not covered under the company's workers' compensation insurance policy? A, medical expenses for the employee's injuries. B, temporary disability benefits while the employee is unable to work. C, permanent disability benefits if the injury results in permanent impairment. D, the employee's legal defense costs in lawsuit against the company. Answer D, the employee's legal defense costs in a lawsuit against the company. Explanation. Workers' compensation insurance covers medical expenses, temporary disability benefits, and permanent disability benefits for employees injured on the job. However, it does not cover legal defense costs for the company in a lawsuit. Workers' compensation provides benefits regardless of fault, but does not cover the company's defense in a lawsuit. Options A, B, and C are standard benefits under workers' compensation. Relevant reference, California Labor Code Section 3200 et seq, workers' compensation. Question 14, life insurance. Term versus whole life insurance. Which of the following is the main difference between term life insurance and whole life insurance in California? A, term life insurance has higher premium than whole life insurance. B, whole life insurance provides coverage for specific period, while term life insurance provides lifetime coverage. C, Term life insurance provides coverage for a specific period, while whole life insurance provides lifetime coverage and has cash value component. D. Whole life insurance requires the insured to pass medical exam, while term life insurance does not. Answer C. Term life insurance provides coverage for a specific period, while whole life insurance provides lifetime coverage and has the cash value component. Explanation: term life insurance provides coverage for a specific period, e.g., 10, 20, or 30 years, and it does not accumulate cash value. On the other hand, whole life insurance provides lifetime coverage and includes a cash value component that grows over time. Option is incorrect because term life insurance generally has lower premiums compared to whole life. Option B is incorrect because the description is reversed. Term life is for a specific period and whole life is for a lifetime. Option D is incorrect because both types can require a medical exam. Relevant reference: California Insurance Code Section 10113, Life Insurance Types. Question 15, Property Insurance. Conditions for coverage: which of the following is not typical condition for coverage under homeowners insurance policy HO3 in California? A. The insured must maintain the property in good repair. B. The insured must provide prompt notice of any loss or damage. C. The insured must pay the premium within 10 days of the due date. D. The insured must allow the insurer to inspect the property regularly. Answer D. The insured must allow the insurer to inspect the property regularly. Explanation: while insurers may have the right to inspect the property after a loss, they do not typically require regular inspections as a condition for coverage. However, the insured must maintain the property in good repair and provide prompt notice of any loss or damage. Option is correct: maintaining property as a condition. Option B is correct: prompt notice is a requirement. Option C is correct: paying the premium is a condition for maintaining coverage. Relevant reference: California Insurance Code Section 2071, Homeowners Insurance Conditions. Question 16, Commercial Liability Insurance. Coverage for non-profit organizations. Non-profit organization in California is sued for bodily injury caused by slip and fall at its facility. Which of the following would not be covered under the non-profit's commercial general liability CGL policy? A. Medical payments for the injured party. B. Bodily injury caused by the non-profit's negligence. C. Bodily injury caused by an intentional act of an employee. D. Legal defense costs for the non-profit organization. Answer C. Bodily injury caused by an intentional act of an employee. Explanation: a commercial general liability CGL policy generally does not cover intentional acts of the insured or their employees. Bodily injury caused by negligence is covered, as well as medical payments and defense costs for lawsuits. Options A, B, and D are covered under the CGL policy. Relevant reference: California Insurance Code Section 11580, Commercial General Liability Coverage. Question 17, Health Insurance. HMO versus PPO. Which of the following is distinct feature of preferred provider organization PPO compared to health maintenance organization HMO in California? A. PPO requires members to select primary care physician, but PPO members must receive care only from in-network providers to receive benefits. C. PPO plans allow members to see any provider without referral. D. HMO plans have higher premiums and out-of-pocket costs than PPO plans. Answer C. PPO plans allow members to see any provider without a referral. Explanation: PPO allows members to see any healthcare provider without requiring a referral from a primary care physician. This flexibility is in contrast to HMO, which requires members to have a referral to see specialists and often requires selecting a primary care physician. Option applies to HMOs, not PPOS. Option B applies to HMOs that focus on in-network care. Option D is inaccurate, as PPOS generally have higher premiums than HMOs. Relevant reference: California Insurance Code Section 1345 et sec. HMO and PPO coverage. Question 18, Property Insurance. Flood insurance. Which of the following is not covered under standard homeowners insurance policy HO3 in California? A. Fire damage to the home. B. Theft of personal property. C. Flood damage to the home. D. Windstorm damage to the roof. Answer C. Flood damage to the home. Explanation: a standard HO3 policy typically excludes coverage for flood damage. Flood insurance must be purchased separately, usually through the National Flood Insurance Program and FIP. Options A, B, and D are typically covered under a standard homeowner's policy. Relevant reference: California Insurance Code Section 10,085.6 Flood Exclusion. Question 19. Auto insurance. Underinsured motorist coverage. Which of the following would be covered under the underinsured motorist coverage in California auto insurance policy? A. The medical bills of the insured following an accident with driver who has inadequate insurance. B. Damage to the insured's vehicle following hit-and-run accident. C. Injury to passenger in the insured's vehicle after collision with an uninsured driver. D. All of the above. Answer A. The medical bills of the insured following an accident with a driver who has inadequate insurance. Explanation: underinsured motorist coverage pays for the insured's medical bills and other expenses when the at-fault driver's insurance is insufficient to cover the full extent of the damage. It does not cover vehicle damage, which would fall under collision coverage, or a hit-and-run, which may be covered under uninsured motorist coverage. Option is correct. Relevant reference: California Insurance Code Section 11,580.2 Uninsured underinsured motorist coverage. Question 20. Life insurance. Premium payments. Which of the following best describes the grace period for premium payments in life insurance policy in California? A. The insured must pay the premium within 30 days of the due date or the policy will be cancelled. B. The insured has 31 days to pay the premium after the due date before the policy lapses. C. The grace period is 60 days, after which the insurer must pay the death benefit. D. The grace period allows the insurer to charge late fee before coverage is reinstated. Answer B. The insured has 31 days to pay the premium after the due date before the policy lapses. Explanation: in California, a life insurance policy typically provides a 31-day grace period during which the policyholder can pay overdue premiums without the policy lapsing. If the premium is not paid within this period, the policy may be terminated. Option is incorrect because the grace period is 31 days, not 30. Option C is incorrect because the grace period does not automatically result in the insurer paying the death benefit. Option D is not correct because the grace period focuses on allowing the premium to be paid without penalty or lapse. Relevant reference: California Insurance Code Section 10113, Grace Period for Premium Payments. Question 21. Health insurance. Mental health coverage under California law. Health insurance policies must provide coverage for mental health services. Which of the following is not required to be covered under California's mental health parity law? A. Inpatient mental health care. B. Outpatient mental health care. C. Substance use disorder treatment. D. Cosmetic surgery for mental health reasons. Answer D. Cosmetic surgery for mental health reasons. Explanation: California's mental health parity law mandates that health insurance policies cover inpatient and outpatient mental health care and substance use disorder treatment on a parity basis with physical health conditions. However, cosmetic surgery is not required to be covered even if it is related to mental health issues. Options A, B, and C are part of the mandatory coverage under the law. Relevant reference: California Health and Safety Code Section 1374.72 Mental Health Parity. Question 22. Auto insurance. Personal injury protection. Which of the following statements is true about personal injury protection? PIP coverage in California auto insurance policies. A. PIP is required in all California auto insurance policies. B. PIP covers the medical expenses of the insured and passengers, regardless of who caused the accident. C. PIP covers only the medical expenses of the driver and passengers if the driver is at fault. D. PIP provides coverage for damages to the vehicle caused by another driver. Answer B. PIP covers the medical expenses of the insured and passengers, regardless of who caused the accident. Explanation: Personal injury protection (PIP) is an optional coverage in California that provides medical and related expenses for the insured and passengers, regardless of fault in the accident. It does not cover vehicle damage, nor is it required by law. Option is incorrect because PIP is not required in California. Option C is incorrect because PIP covers medical expenses regardless of fault. Option D is incorrect because PIP does not cover vehicle damage. Relevant reference: California Insurance Code Section 11,580.2 Uninsured underinsured motorist coverage. Question 23. Property insurance. Exclusions. Which of the following is not typically excluded under standard homeowners insurance policy Hoffery in California? A. Flood damage. B. Earthquake damage. C. Vandalism. D. Fire damage. Answer D. Fire damage. Explanation. The standard homeowners insurance policy Hoffery typically covers fire damage. However, it excludes coverage for events like flood damage and earthquake damage unless additional coverage is purchased. Option A and B are both exclusions under a standard homeowners policy. Option C is covered under the Hoffery policy. Relevant reference: California Insurance Code Section 10,085.6 Flood Exclusion. Question 24. Commercial insurance. Business interruption coverage. Which of the following is not typically covered under business interruption insurance in California commercial insurance policy? A. Loss of income due to fire. B. Extra expenses to continue business operations. C. Income lost due to employee injury. D. Loss of income due to natural disaster. Answer: C. Income lost due to employee injury. Explanation. Business interruption insurance typically covers income lost and extra expenses incurred due to damage to the business property, e.g. fire or natural disaster. It does not cover income lost due to employee injury, as that would fall under workers' compensation insurance. Options A, B, and D are typical coverages under business interruption insurance. Relevant reference: California Insurance Code Section 533, Business Interruption Coverage. Question 25. Life insurance. Insurable interest in California. Person purchasing life insurance policy must have valid insurable interest in the life of the insured. Which of the following best describes the requirement for insurable interest? A. The policyholder must be family member of the insured. B. The policyholder must have financial stake in the life of the insured. C. The policyholder must be business partner of the insured. D. The policyholder must have legal relationship with the insured. Answer: B. The policyholder must have a financial stake in the life of the insured. Explanation. To purchase a life insurance policy, the policyholder must have insurable interest, meaning they must stand to lose financially from the death of the insured. This can include family members, business partners, or others with a financial stake, but it is not limited to family relationships. Option is only partially correct, as family relationships can create insurable interest but aren't the only condition. Option C is correct for business relationships but does not cover all cases of insurable interest. Option D is incorrect because legal relationships aren't sufficient by themselves. Relevant reference: California Insurance Code Section 10110 Insurable Interest Requirement. Question 26. Health insurance. Pre-existing conditions under California law. Which of the following is not allowed in health insurance policies regarding pre-existing conditions? A. Insurers can deny coverage for pre-existing conditions for the first 6 months. B. Insurers must provide coverage for pre-existing conditions after certain rating period. C. Insurers can increase premiums for individuals with pre-existing conditions. D. Insurers can cancel policies if the insured develops pre-existing condition after the policy has been issued. Answer: D. Insurers can cancel policies if the insured develops a pre-existing condition after the policy has been issued. Explanation: California law, in accordance with the Affordable Care Act, prohibits insurers from canceling policies due to the development of a pre-existing condition once the policy has been issued. Insurers can impose waiting periods but cannot deny coverage after the waiting period or cancel a policy due to a pre-existing condition. Option A and B are allowed under ACA provisions. Option C is incorrect because increasing premiums for pre-existing conditions is also prohibited. Relevant reference: California Health and Safety Code Section 1340, Pre-existing conditions coverage. Question 27. Commercial insurance. Product liability. Which of the following would not be covered under product liability insurance policy in California? A. Injuries caused by defective product. B. Harm caused by product when used as intended. C. Claims made for defective product sold to customer. D. Claims made for the failure to provide proper warnings about product. Answer: B. Harm caused by a product when used as intended. Explanation: product liability insurance typically covers claims related to defective products that cause injuries or harm when used as intended, or if the product fails. However, harm that occurs when the product is used in an unintended or negligent manner may not be covered. Options A. C, and D are common types of claims covered under product liability insurance. Relevant reference: California Civil Code Section 1792, Product Liability Insurance. Question 28, Property Insurance. Coverage limits in California. Homeowners insurance policy HO3, which of the following best describes coverage limits for personal property? A. The policy will automatically cover 100% of the value of personal property. B. The policy covers personal property only for the amount specified in the policy declarations. C. The policy covers personal property up to limit of $100,000. D. The policy automatically increases coverage for personal property annually. Answer: B. The policy covers personal property only for the amount specified in the policy declarations. Explanation: the coverage limit for personal property is specified in the policy declarations and is generally a set amount which can be increased or decreased based on the needs of the insured. Option is incorrect because personal property coverage is subject to a specified limit. Option C is incorrect because the amount may vary depending on the policy. Option D is incorrect because the policy does not automatically increase coverage for personal property unless specified. Relevant reference: California Insurance Code Section 2071, Homeowners Insurance. Question 29, Workers' Compensation. Temporary disability in California. What is the maximum duration of temporary disability benefits available to an injured worker under workers' compensation insurance? A. 52 weeks. B. 104 weeks. C. 240 weeks. D. Lifetime benefits. Answer: B. 104 weeks. Explanation: California workers' compensation law provides for temporary disability benefits up to a maximum of 104 weeks. After this period, workers may transition to permanent disability benefits or other forms of compensation. Option is incorrect. The duration is 104 weeks, not 52. Options C and D are incorrect. The duration is limited to 104 weeks. Relevant reference: California Labor Code Section 4656, Temporary Disability Benefits. Question 30, Health Insurance. Cover benefits. Which of the following is not typically covered under California Health Maintenance Organization (HMR) policy? A. Emergency care. B. Preventive services. C. Out-of-network care. D. Inpatient hospitalization. Answer: C. Out-of-network care. Explanation: HMOs typically require members to receive care from in-network providers and generally do not cover out-of-network care except in emergencies. Options A, B, and D are typically covered under an HMO. Relevant reference: California Health and Safety Code Section 1373.1, HMO coverage.